In early 2025, the global economy stood at a precipice. President Donald Trump, aiming to rejuvenate American manufacturing, announced sweeping tariffs, a 25% levy on all steel and aluminum imports effective March 12. This bold move sent shockwaves through international markets, igniting fears of an all-out trade war. The initial tremors were felt on Wall Street. Major indices, including the Nasdaq, suffered their most severe declines since 2022, with tech giants like Tesla and Apple bearing the brunt of the sell-off. Investors, gripped by uncertainty, watched as billions were wiped from portfolios overnight. But the repercussions didn't stop at the U.S. border. Key trading partners, notably Canada and the European Union, retaliated with their own tariffs, targeting a wide array of American goods. Canada, the largest supplier of steel and aluminum to the U.S., imposed counter-tariffs worth CAD $29.8 billion. The European Commission announced equivalent countermeasures set to begin on April 1 involving tariffs on various products. This tit-for-tat escalation raised alarms about a looming global recession as the foundations of international trade began to fracture. Amidst the turmoil, economists introduced a new term to the lexicon, Trumpsession. This portmanteau encapsulated growing fears that the president's unpredictable economic strategies could steer the U.S. into a significant downturn. Indicators such as reduced consumer spending, a record trade deficit, and a notable dip in consumer confidence fueled these anxieties. The ripple effects extended beyond North America. Global markets experienced heightened volatility, with major indices in Europe and Asia facing declines. The interconnectedness of the global economy meant that U.S. trade policies could disrupt international supply chains and dampen economic growth worldwide. Escalating trade tensions and tariff policies. In a bold move to bolster American manufacturing, President Donald Trump announced on March 3, 2025, a sweeping 25% tariff on all steel and aluminum imports, effective March 12. This aggressive policy sent shockwaves through the global economy, igniting fears of an all-out trade war. The European Union wasted no time in striking back. On March 12, they unveiled counter-tariffs targeting $28 billion worth of U.S. goods, including iconic American products like bourbon whiskey, motorcycles, and agricultural goods. These measures, set to commence on April 1, were a direct response to what they perceived as unjust U.S. trade practices. The situation with Canada, the largest supplier of steel and aluminum to the U.S., quickly deteriorated. President Trump threatened to double tariffs on Canadian metals to 50% and hinted at imposing duties on automobiles if Canada didn't alter its trade practices. In retaliation, Ontario Premier Doug Ford imposed a 25% surcharge on electricity exports to the U.S., further straining relations. These escalating tensions sent financial markets into a tailspin. Major indices experienced sharp declines, reflecting investor anxiety over potential retaliatory measures and disrupted supply chains. Companies with substantial exposure to international trade, such as Caterpillar Inc. and Boeing, saw significant losses in their stock prices. Immediate impact on the stock market. The financial markets reacted swiftly and sharply to President Trump's aggressive trade policies, with investors scrambling to reassess their positions amid escalating tensions. On March 11, 2025, the Dow Jones Industrial Average nosedived nearly 600 points, before closing down 478.23 points, a 1.1% drop. This decline followed a 900-point tumble the previous day, marking one of the most volatile periods for the index in recent years. The tech-heavy Nasdaq composite wasn't spared, experiencing its worst session since 2022. Major technology companies, including Tesla and Apple, saw significant declines as investors grew anxious about the potential ripple effects of a global trade war on supply chains and international sales. The abrupt policy shifts and escalating trade tensions eroded investor confidence. The VIX, often referred to as the Fear Index, spiked by 4% to 29.14, reflecting heightened market anxiety. Major global stock markets also felt the tremors, with indices across Europe and Asia registering notable declines. The escalating trade war and resulting market volatility have raised alarms about a potential economic slowdown. Major banks have revised their growth forecasts downward, and some economists warn of an increased probability of a recession if tensions persist. Rising recession fears. The escalating trade tensions and resultant market volatility have ignited widespread concerns about a looming recession, with both economists and investors on high alert. Several key economic indicators are signaling potential trouble ahead. Consumer confidence, the University of Michigan's Consumer Sentiment Index, dropped to its lowest level in a decade, reflecting growing apprehension among consumers about future economic conditions. Manufacturing slowdown. The Institute for Supply Management reported a contraction in manufacturing activity for the second consecutive month, indicating reduced industrial output. Inverted yield curve. The yield on 10-year U.S. Treasury notes fell below that of 2-year notes, a phenomenon historically associated with impending recessions. Prominent economists are voicing concerns that the current trajectory could lead to a significant economic downturn. Trade policy critiques. Experts argue that the aggressive tariff strategy may backfire, leading to higher consumer prices and strained international relations. Growth forecasts slashed. Financial institutions have revised GDP growth projections downward, with some models predicting a contraction in the coming quarters. The general populace is also feeling the strain. Retirement worries. Individuals nearing retirement express concern over the diminishing value of their investment portfolios, questioning the security of their financial futures. Job security fears. Workers in industries vulnerable to trade disruptions, such as manufacturing and agriculture, are increasingly anxious about potential layoffs. The administration's handling of the situation is facing criticism. Policy uncertainty. Frequent shifts in trade policy have created an unpredictable business environment, hindering long-term planning for companies. Calls for intervention. There are growing demands for the Federal Reserve and other governmental bodies to take action to stabilize the economy and restore confidence. In summary, the confluence of trade disputes, market instability, and deteriorating economic indicators has heightened fears of a recession, prompting calls for decisive policy interventions to avert a potential economic downturn. Global economic ramifications. The aggressive trade policies implemented by President Trump have sent shockwaves through the global economy, triggering a series of retaliatory measures and market reactions that underscore the interconnectedness of today's economic landscape. In swift retaliation to the U.S. tariffs, the European Union imposed counter-tariffs on $28 billion worth of American goods, targeting products such as bourbon, motorcycles, and agricultural goods. These measures, set to commence on April 1st, were a direct response to what the EU perceived as unjust U.S. trade practices. The escalating trade tensions have led to heightened volatility in global financial markets. European stocks. Despite initial declines, European stock markets rallied as the EU imposed retaliatory tariffs, with Germany's DAX and France's CAC 40 experiencing gains. Asian markets. Major indices in Asia faced declines, reflecting investor anxiety over potential disruptions to international supply chains and economic growth. Economists warn that prolonged trade disputes could dampen global economic growth. Trade disruptions, the tit-for-tat tariffs, threaten to disrupt established supply chains, increasing costs for businesses and consumers alike. Inflationary pressures. Central banks are concerned that tariffs may push up inflation, complicating monetary policy decisions. The escalating trade tensions place central banks in a precarious position. Policy uncertainty. The U.S. Federal Reserve is closely monitoring the situation, but has indicated no immediate plans to cut interest rates, emphasizing the need for greater clarity before making policy adjustments. Global responses. Other central banks, such as the European Central Bank, are considering measures to stimulate their economies in response to the trade tensions. In summary, the escalating trade tensions initiated by the U.S. have set off a chain reaction of retaliatory measures and market volatility, raising alarms about a potential global economic slowdown and placing central banks worldwide in a challenging position as they navigate this complex landscape. Government and central bank responses. As trade tensions escalated and markets trembled, all eyes turned to the world's central banks and governments, anticipating decisive actions to stabilize the teetering global economy. The U.S. Federal Reserve found itself in a precarious position, striving to balance the dual mandates of controlling inflation and sustaining economic growth. Despite mounting pressures, Fed Chair Jerome Powell maintained a cautious stance, emphasizing the need for clear evidence of economic downturn before adjusting interest rates. This measured approach aimed to prevent hasty policy shifts that could further destabilize the economy. Around the globe, central banks adopted varied strategies in response to the unfolding crisis. European Central Bank (ECB), confronted with stagnating growth, the ECB implemented rate cuts and revived quantitative easing measures to inject liquidity into the Eurozone economy. Bank of Japan (BOJ), the BOJ continued its aggressive monetary easing policies, aiming to counter deflationary pressures exacerbated by the trade disputes. People's Bank of China (PBOC), in an effort to stabilize its economy amid escalating tariffs, the PBOC reduced reserve requirements for banks, encouraging increased lending and domestic investment. National governments also rolled out fiscal policies to mitigate the adverse effects of the trade war. United States, the U.S. administration proposed stimulus packages, including infrastructure spending and tax reliefs, to bolster domestic demand and offset the downturn in exports. European Union (EU) member states coordinated fiscal responses, increasing public investments and providing subsidies to industries most affected by the tariffs. Market reactions and investor sentiment. Despite these interventions, investor confidence remained fragile. Stock markets experienced wild swings as traders reacted to each new policy announcement and economic indicator. In summary, the intersection of President Trump's tariff policies, stock market volatility, and rising recession fears paints a complex picture of the current economic landscape. As trade tensions persist, both domestic and global economies face uncertainty, underscoring the need for careful policy considerations and strategic responses from governments and financial institutions alike.